most of the clients and the advisors really think that putting the 20% down, the difference in the payment is going to be a huge difference by putting 20 versus 10. And when you look at the numbers, it can be a lot, but it's usually not worth, as I say, the juice is not worth the squeeze to put down the 20%.
Hi, this is Dave Steinberg, and this is the Mortgages Made Easy podcast. Back with my buddy, Jeff Thomas. Jeff and I have been talking about different scenarios that financial advisors may encounter, that accountants may encounter. And one of the things we were talking about is what we call the second look. Jeff, right. Take it away.
Well, second look is just really what it means. It's somebody that has come in and gone to their advisor and says, what do you think about this offer that I have right here from somebody? And the second look is for us to take a look at what they have and see, A, is it a good offer? And B, is there ways that we can assist them in a better use of their funds?
So do you have any examples where second look might be really great value?
Well, yeah, I one that came to me, I had a client call and they sent me their it was a HUD or a CD, however you want to call it, their estimate. And as I was going through it, there were fees that I didn't think should be there. And so I was able to actually help them get a better deal. Ironically, it was through me, which is good, but they got a better deal because they reached out and they weren't sure what they thought. They had a great deal, but they literally had a bad deal. And so that, that conversation saved them money.
Yeah. The scenario that I like to share is a buyer walks into your office and your financial advisor, and they say, here's the mortgage offer. What do you think? Here's my mortgage quote. What do you think? And many financial advisors don't have the tools to personally analyze that. And that's where we come in useful, because we'll do this for free with no obligation. We won't, obviously, we're going to respect your relationship with clients, so there's no hard sell. If they've got a good offer, we're gonna acknowledge that, and so you can acknowledge that. But I'll give you a couple of examples of ways that we've helped clients that would be non-obvious. And one is, when we look at the client scenario, we look at their total debt picture and asset picture, but we look at their total debt picture. And we have a client who has about $40,000 in student loan debt. And it's actually not even government loan debt, so it'll never be forgiven. It's just they have whatever it is, whatever bank it is, private bank has $40,000. Their payments are high on it. We were able to show them how, if instead of putting down 20% on their mortgage, they put down 10% and paid off the student loan, that they would be in a far better financial situation. To take a different version of that, clients buying a home and they're putting down 20%, but they're concerned because there's renovations that they know the house needs to make it ready for them. And if they put down the 20%, they're concerned about where the rest of the money's coming from. And we can do an A/B comparison and show them, well, here's what you're planning now. What if you did it this way? And then, the financial advisor becomes the hero because they've brought in new resources to address a client problem. And that's what we're all about.
Right. I've found in those same examples is that most of the clients and the advisors really think that putting the 20% down, the difference in the payment is going to be a huge difference by putting 20 versus 10. And when you look at the numbers, it can be a lot, but it's usually not worth, as I say, the juice is not worth the squeeze to put down the 20%. Most people, when they look at it, put down less. The advisor likes it because it's treating their client's money with respect. And the client likes it because they're not putting all their funds into their house. So I think most people are fooled by the larger down payment is actually a less monthly payment, smaller monthly payment, when in reality, it's not that much.
And in that particular situation, when we're talking about going below 20%, everyone knows about mortgage insurance. And in our world, mortgage insurance is the boogeyman.
It is.
Like, oh no, you're going to have mortgage insurance. But the truth is that for clients with great credit, mortgage insurance has become far less expensive. It's probably costs, a third of what it cost 20 years ago. And so if you have a client who is straddling that situation, should I put down 20%? Should I not put down 20%? You may be pleasantly surprised how putting down 10% might be putting down 10% might be an overall better financial decision for the client. And that's what we're all about.
Yeah. That I kind of played the game on one where I had the client put down just literally $100 less than 20%. They got a better rate, and they made one payment, had the MI removed within 1 or 2 payments, and they got a better deal. They got a better rate. And I've had the clients put down the 10% because, as you said, mortgage insurance is not as expensive as it used to be many years ago. It's not a financial albatross.
Well, this has been great, Jeff. Thank you so much for taking the time.
Thanks, Dave. Appreciate it.